Hi everyone, I'm Abhishek. Today I would like to talk to you about an interesting investment opportunity for 3 to 6 months. You see, in the debt markets, something very interesting happens during this time of the year. Every year, between January and March, short-term interest rates move up and then they cool off sharply in April and May. This is what we colloquially call the Jan to March phenomena, and it can create attractive opportunities for investors. So, why does this happen? Towards the end of the financial year, banks need to strengthen their balance sheets and shore up their deposits to meet regulatory and reporting requirements. To do this, they borrow more through short term instruments like certificates of deposit or CDs. At the same time, liquidity in the system tightens due to seasonal factors such as advanced tax payments, cash withdrawals, and forex related outflows, etc. Put together, these factors push short term interest rates higher. This year, however, the situation is even more pronounced. You see, while the overall system liquidity is comfortable, banks are grappling with tight liquidity. The loan book of banks is growing faster than deposits, and the credit deposit ratio is at an all-time high of around 82% compared to its yearly low of around 79%. To fund this gap between credit and deposit growth, banks are borrowing aggressively in the CD markets at higher rates. This has created a large gap with one-year CD rates at around 180 to 200 basis points higher than overnight rates. This distortion has pushed up yields and improved return potential for certain debt mutual fund categories. Now, what goes up tends to come down. Historically, once the new financial year begins, liquidity usually improves and short-term rates tend to soften in April and May months. And when rates fall, bond prices rise, creating the potential for better outcomes. For example, in 2025, short-term rates compressed by around 70 to 75 basis points during this phase. And we saw a similar movement in 2023 and 2024, where rates came down by 35 to 45 basis points in April and May. While this is only illustrative, it shows how such periods can create favorable conditions for investors who position themselves when yields are high. Today's higher yields have already lifted portfolio yields, setting the stage for attractive return potential. Funds at the shorter end of the curve, such as money market funds and ultra-short duration funds, they invest meaningfully in this segment. They are well positioned to benefit if this seasonal rate compression plays out. As always, investors should align their investments with their goals and risk profile. But understanding these seasonal patterns can help make smarter and more timely decisions. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.